Now we are starting a new lesson called Backtest and Journal. This lesson is about testing your strategy and learning from every trade. A professional trader does not guess. A professional trader tests, records, reviews, and improves. This is very important because many beginners believe confidence comes from a feeling. They may say, "I think the strategy will work," or "This setup looks good." But professional confidence does not come from hope. Professional confidence comes from evidence. There are 3 important steps on this slide. The first step is test. Testing means checking how a strategy performed in the past. We want to know if the rules made sense, how often the strategy worked, what the losses looked like, and whether the reward was worth the risk. The second step is record. Recording means writing down every trade. We should record the entry, stop, loss, target, result, market condition, and reason for taking the trade. The third step is review. Reviewing means looking back at the trades to find patterns. Are we following the rules? Are we entering too late? Are we moving stops? Are we taking trades in bad market conditions? The main message is this: confidence comes from evidence, not hope. If we test our strategy and journal our trades, we can improve over time. Without testing and journaling, we are just guessing. A professional trader learns from the data, not from emotion.
Now let's talk about what backtesting is. Backtesting means checking how your exact strategy rules would have performed in the past. This is important because we do not want to trade based only on hope or opinion. We want evidence. Backtesting helps us answer important questions. The first question is, where would I enter? This means we check the chart and apply the entry rule exactly the same way every time. The second question is, where would I place the stop? Before testing the trade, we must know where the trade idea becomes wrong. The third question is, where would I take profit? We need to know the target before judging whether the trade worked or failed. The fourth question is, how many setups won or lost? This helps us understand whether the strategy has potential over many trades, not just one example. The fifth question is, what market conditions worked best? Some strategies work better in trending markets. Some work better after pullbacks. Some fail in choppy markets. The main lesson is this: backtesting replaces guessing with evidence. One good trade does not prove a strategy works. A reliable test needs many examples. The goal is to find repeatable behavior. If the same rules work again and again in similar conditions, then we may have a strategy worth studying. But if the results are random, the strategy may need improvement. A professional trader does not just ask, "Did this trade work?" A professional trader asks, "Does this setup work consistently over many trades?"
Now let's talk about why backtesting matters. A strategy should be judged by data, not by excitement after one winning trade. Many beginners make this mistake. They take one trade, it works, and they think they found a great strategy. But one winning trade does not prove anything. A real strategy needs to be tested over many trades and different market conditions. Backtesting helps us discover 3 important things. The first one is performance numbers. This includes win rate, average winner, average loser, profit factor, and biggest drawdown. Win rate tells us how often the strategy wins. Average winner tells us how much we usually make when the trade works. Average loser tells us how much we usually lose when the trade fails. Profit factor compares total profit to total losses. Biggest drawdown tells us how much the account may fall during a bad period. The second thing backtesting helps us find is behavior patterns. We may discover the best time of day to trade. We may find the best ticker or market for the strategy. We may learn which setup type works best. We may also discover the worst market condition for the strategy. For example, maybe the strategy works well in a trending market, but fails in chop. Backtesting also helps us understand losing streak risk. This is important because even a good strategy can have several losses in a row. The third thing backtesting shows us is risk reality. It helps us understand how much pain the strategy creates. How often do losses happen? Can the account survive the drawdowns? Can the trader follow the strategy emotionally when it has losing trades? The main lesson is this: backtesting helps us see the truth before risking real money. It shows us whether the strategy has potential, where it works best, and whether we can handle the risk.
Now let's talk about why clear rules come first. Before we backtest any strategy, the rules must be clear. If the rules are not clear, the backtest will not be reliable. Bad rule sounds like this. I buy when the chart looks good. That is not a real rule because looks good can mean different things to different people. One day the trader may think the chart looks good because price is going up. Another day they may think it looks good because RSI is low. Another day they may enter because they feel excited. That creates inconsistent testing. Now let's look at a good rule. I buy when price is in an uptrend, pulls back to support, and closes above the prior candle high with volume. This rule is much better because it is specific. Tells us the market condition. Tells us the setup. Tells us the entry trigger. It also includes confirmation from volume. Before testing, we need rules for several things.
Now, let's talk about the manual backtesting workflow. Manual backtesting means we go back on the chart and test the strategy one candle at a time. This helps train our eyes to recognize real setups. It also helps us understand how the strategy behaves in different market conditions. The first step is to pick one strategy. Do not test 5 strategies at the same time. Choose one clear strategy with exact rules. The second step is to pick one market. For example, you may choose one stock, one ETF, one futures contract, or one index. The third step is to choose one time frame. You may test a 1-minute chart, 5-minute chart, daily chart, or any time frame that matches your trading style. The fourth step is to scroll back on the chart. Go back to a past period where you cannot see what happens next. This helps keep the test honest. The fifth step is to move candle by candle. Do not jump ahead. Move one candle at a time so you are testing the setup like it was happening live. The sixth step is to record every valid setup. This is very important. We do not only record the trades that look good after the fact. Every setup that matches the rules must be counted. The seventh step is to track the result. Write down whether the trade won, lost, hit the stop loss, hit the target, or failed because of market conditions. The eighth step is to review the data. After enough trades, look for patterns. Ask which setups worked best, which market conditions were bad, and whether the strategy is worth improving. The key lesson is this: keep the test honest. Every valid setup must be counted, not just the trades that look good after the fact. A professional trader does not backtest to prove they are right. A professional trader backtests to find the truth.
Now let's talk about automated backtesting. Automated backtesting means using software to test a strategy faster. Instead of manually moving candle by candle, the software can test many trades over a long period of time. This can save a lot of time. But there is one very important rule. Automated backtesting only works well if your rules are exact. If the strategy rules are unclear, the software cannot test them properly. Some common platforms for automated backtesting include TradingView Strategy Tester, Thinkorswim, Python, NinjaTrader, TradeStation, and Interactive Brokers tools. These platforms can help traders test entries, exits, stop losses, targets, and performance results. But we must be careful. The code must match the real strategy. If the code is wrong, the backtest results will also be wrong. We also need to avoid overfitting old data. Overfitting means making the strategy look perfect on past data by changing too many settings. The problem is that it may fail in live trading. We also need to include commissions and slippage. Commissions are trading costs. Slippage happens when the real execution price is different from the expected price. These costs can make a big difference, especially for scalping and day trading. We also need to check if live execution is realistic. A strategy may look good in a backtest, but in real trading the fills, speed, spreads, and market conditions may be different. Finally, we should always review charts visually. Do not only trust the numbers. Look at the trades on the chart and make sure the entries and exits make sense. The main lesson is this: automated backtesting is powerful, but only when the rules are clear, the code is accurate, and the results are reviewed carefully. A professional trader uses software to test faster, but still thinks critically before risking real money.
Now let's talk about what to track in a backtest. When we backtest a strategy, we should track both trade details and performance metrics. Trade details help us understand what happened on each trade. Performance metrics help us understand whether the strategy is actually working over many trades. First, we track the date and ticker. This tells us when and where the setup happened. Next, we track the entry and exit. These are the exact prices used for the trade. We need this so the test is clear and honest. Then we track the stop loss and target. This shows the risk and reward plan before the trade starts. Next, we track profit or loss. This tells us the final result of the trade. We also track the market condition. Was the market trending? Was it moving sideways? Was volatility high or low? Was there news? This is important because some strategies work better in certain market conditions. We also write setup notes. Setup notes explain why the trade qualified. This helps us see whether we followed the rules or forced the trade. Now let's look at the performance metrics. The first metric is win rate. Win rate tells us the percentage of trades that won. Next is average win. This tells us the average profit on winning trades. Then we track average loss. This tells us the average loss on losing trades. Next is profit factor. Profit factor compares total gross profit to total gross loss. It helps us see whether the strategy makes more money than it loses. Then we track drawdown. Drawdown shows the largest account drop from a high point. This helps us understand how painful the strategy can be during losing periods. Finally, we track expectancy. Expectancy tells us the average expected result per trade. The main lesson is this. A good backtest is not just about asking, "Did this trade win?" A good backtest asks, "What happened? Why did it happen? Was the setup valid? What market condition was best? How much did winners make compared to losers? Can this strategy survive losing streaks?" When we track the right information, the backtest becomes a learning tool.
Now, let's talk about why win rate is not everything. Many beginner traders focus only on win rate. They may think a strategy with a high win rate is automatically good, and a strategy with a lower win rate is automatically bad. But that is not always true. A strategy can make money even if it has more losing trades than winning trades. On this slide, we have an example of a 40% win rate. That means out of 10 trades, only 4 trades win and 6 trades lose. At first, that may sound bad, but now let's look at the numbers. The 4 winning trades make $300 each. So, 4 wins times $300 equals $1,200. The 6 losing trades lose $100 each. So, 6 losses times $100 equals $600 loss. Now we subtract the losses from the wins. $1,200 to $600 equals $600 net profit. So, even though the trader lost more trades than they won, the strategy still made money. Why? Because the winners were bigger than the losers. That is the key lesson. Win rate alone can be misleading. Risk to reward matters. Average win and average loss are very important. A strategy with a high win rate can still lose money if the losses are too large. And a strategy with a lower win rate can still make money if the winners are much bigger than the losers. So when we backtest, we should not only ask, what is the win rate? We should also ask, how big is the average winner? How big is the average loser? What is the risk to reward? What is the profit factor? Can the strategy survive losing streaks? The main lesson is this. The key is whether the winners are bigger than the losers. A professional trader studies the full math, not just the win rate.
Now let's talk about drawdown. Drawdown measures how painful a strategy can be. In simple words, drawdown is the drop from an account high before the account recovers. For example, let's say a trading account grows to $10,000. Then the account drops to $9,000. That means the account lost $1,000 from its high. So the drawdown is $1,000 or 10%. This is important because every strategy will have losing periods. Even a good strategy can have drawdown. The question is not, will this strategy ever lose? The real question is, can I survive the losing period and still follow the plan? Large drawdowns can hurt confidence. They can make traders emotional. They can cause traders to stop following the strategy at the wrong time. A large drawdown can also be financially dangerous if the trader is risking too much. That is why we must understand drawdown before trading real money. Profit matters, but survival matters first. The main lesson is this. A strategy must be financially and mentally manageable. If the drawdown is too large, the trader may not be able to follow the strategy long enough to benefit from it. A professional trader studies drawdown because they want to know the real risk, not just the possible reward.
Now let's talk about forward testing. Forward testing means testing the strategy in real time without risking real money, usually by using paper trading. Backtesting shows us what happened in the past. Forward testing shows us whether we can follow the rules live. This is very important because trading in real time feels different from looking at old charts. When the market is moving live, emotions can appear. A trader may feel fear, excitement, impatience, or doubt. That is why forward testing is so useful. To forward test properly, the first step is to use paper trading. Paper trading allows us to practice the strategy without risking real money. The second step is to trade only when the rules are met. We do not take random trades. We wait for the exact setup and entry trigger. The third step is to record every trade. Just like backtesting, we need to track the entry, stop loss, target, result, and market condition. The fourth step is to not change the rules daily. This is a common beginner mistake. If the trader changes the rules after every few trades, they will never know if the strategy actually works. The fifth step is to compare the forward test results with the backtest data. If the forward test is very different from the backtest, we need to ask why. Maybe the market condition changed. Maybe the trader did not follow the rules. Maybe the backtest was not realistic. Maybe live execution is harder than expected. The main lesson is this. Backtesting shows what happened in the past. Forward testing shows whether the trader can execute the strategy live. Real-time discipline is part of the strategy. Confidence grows from repetition. A professional trader does not rush from backtesting straight into full-size live trading. A professional trader tests, practices, records, reviews, and improves before risking serious money.
Now let's talk about the trading journal. A trading journal turns every trade into a lesson. This is very important because if we do not record our trades, we may keep making the same mistakes without realizing it. A journal helps us answer important questions. The first question is, am I following my rules? A trader may think they are following the strategy, but the journal will show the truth. The second question is, which setups work best? After many trades, we may notice that certain setups perform better than others. The third question is, which mistakes repeat? Maybe the trader is entering too early, moving stops, chasing trades, or trading during bad market conditions. The fourth question is, what time of day works best? Some strategies work better in the morning. Some work better after lunch. Some work better near the close. The fifth question is, am I emotional when I lose? This is very important because emotions can cause revenge trading, oversizing, and poor decisions. The sixth question is, am I improving? The goal of journaling is not just to collect information. The goal is to become a better trader. Every trade in the journal should include important details. We should record the date, ticker, and whether the trade was long or short. We should record the strategy name and setup. We should record the entry, stop loss, target, and exit. We should record the profit or loss. We should write the reason for the entry and exit. We should include screenshots before and after the trade. We should also write the mistake made and the lesson learned. Finally, we should record our emotion level. Were we calm? Were we nervous? Were we angry? Were we trying to make money back? The main lesson is this. A journal helps us see patterns in our trading behavior. A professional trader does not only review wins and losses. Professional trader reviews decisions, emotions, mistakes, and improvements. That is how a trader grows over time.
Now, let's talk about trade grading. Trade grading means judging the quality of the decision, not only the profit or loss. This is very important because not every good trade will make money, and not every bad trade will lose money. Sometimes you can follow all your rules, take a clean setup, manage risk properly, and still lose money. That can still be an A trade. An A trade means you followed all the rules and the setup was clean. A-B trade means you mostly follow the rules, but there was a small issue. Maybe the entry was a little late, or the setup was not perfect, but the trade still followed most of the plan. AC trade means the setup was weak, the entry was late, or the risk was poor. This trade may not be terrible, but it shows that the trader was not fully disciplined. An F trade means the trade was emotional or the trader broke the rules. This would be revenge trading, chasing, oversizing, moving the stop, or entering without a real setup. The important lesson is this. An A trade can lose money. That does not mean it was a bad trade. It means the market simply did not reward the setup that time. Also, an F trade can make money, but that does not make it a good trade. If a trader breaks rules and makes money, it can create bad habits. The goal is not to chase random profit. The goal is to build discipline. A professional trader wants more trades, fewer C trades, and no F trades. Over time, good decisions matter more than one lucky result. Now, let's talk about the weekly review. Improvement happens when you study your own behavior. Many traders trade all week, but they never review what they did. That is a mistake. If we do not review our trades, we may keep repeating the same mistakes over and over again. A weekly review helps us slow down and learn from the data. The first question is, what setup made the most money? This helps us see which setup is working best. The second question is, what setup lost the most money? This helps us understand which trades may need improvement or which setups we should avoid. The third question is, did I follow my stop loss? This is very important. If we are moving stops or ignoring stops, risk is not under control. The fourth question is, did I overtrade? Overtrading usually happens when we are bored, emotional, or trying to make money back. The fifth question is, did I trade during bad conditions? Maybe the market was choppy, volume was low, or major news was coming. These conditions can make good setups fail. The sixth question is, what mistake repeated? If the same mistake keeps happening, that is the area we need to fix first. The seventh question is, what should I improve next week? We do not need to fix everything at once. Each week, we can focus on one or two improvements. Now, let's look at common beginner mistakes. Some beginners do not track their trades. Some change strategy too quickly. Some only remember the winners and ignore the losers. Some skip screenshots, do not record emotions, or start trading real money before testing. The main lesson is this. A weekly review turns trading experience into trading improvement. A professional trader does not just trade. A professional trader studies their decisions, learns from mistakes, and improves 1 week at a time. Now, let's talk about the simple checklist before trading live. This checklist should be used before putting real money at risk. Many beginners want to go live too quickly. They test a strategy a few times, see 1 or 2 winners, and then start trading real money. That is risky. Before trading live, we need proof, practice, and discipline. The first item is, test at least 50 to 100 trades. 1 or 2 trades are not enough. We need many examples to understand how the strategy really performs. The second item is, know the win rate. We should know what percentage of trades usually win. The third item is, know average win and average loss. This is very important because win rate alone is not enough. We need to know whether winners are bigger than losers. The fourth item is, know the biggest drawdown. We need to understand how painful the strategy can be during losing periods. The fifth item is, know the best market condition. Some strategies work best in trends. Some work better after pullbacks. Some fail in chop. We need to know where the strategy performs best. The sixth item is, forward test of the rules. This means we practice a strategy in real time, usually with paper trading. The seventh item is, can follow the plan without emotion. If we move stops, chase trades, revenge trade, or oversize, we are not ready for live trading yet. The eighth item is, have a journal template. Every live trade should be recorded so we can learn from it. The ninth item is, review trades weekly. A weekly review helps us find mistakes, improve discipline, and understand what is working. The 10th item is, improving over time. The goal is not perfection. The goal is steady improvement. The main lesson is this: do not go live just because you are excited. Go live only when the strategy has been tested, the rules are clear, the risk is controlled, and you can follow the plan with discipline. A professional trader prepares before risking real money.
Now let's finish with a simple teaching summary. Backtesting and journaling are two of the most important habits a trader can build. Backtesting helps us understand the strategy. Journaling helps us understand ourselves. First, backtesting checks if a strategy worked in the past. It helps us see whether the rules had potential before risking real money. Second, forward testing checks if we can follow the strategy in real time. This is important because trading live, even on paper, feels different from looking at old charts. Third, journaling records the full trade. A good journal includes the entry, exit, stop loss, target, emotions, mistakes, screenshots, and lessons learned. Fourth, win rate alone is not enough. A strategy can have a lower win rate and still make money if the winners are bigger than the losers. Fifth, drawdown matters. We need to know how painful the strategy can be during losing periods, because a strategy must be mentally and financially manageable. Sixth, good traders review and improve. They do not just trade and forget. They study their trades, find patterns, correct mistakes, and get better over time. The best closing line is this: backtesting gives you confidence in the strategy. Journaling gives you confidence in yourself as a trader. That is the main lesson. A professional trader does not guess. A professional trader tests, records, reviews, and improves.